I'm going to show you 5 strategies that I use to trade all market conditions. That's the beautiful aspect of options, is our ability to form fit them to the current markets. Like right now it's 2022. It's a bear market. We've had a down year. However, I'm up on the year. And it's not because I'm a magician. It's simply because I have different tools that I can apply to different scenarios. I'm not stuck just doing 1 or 2 things, hoping that the market lines up with those. What's up, everybody? Eric here. Welcome back to All the Outliers. Let's talk about some strategies. So first, I'm going to get my stupid face out the way, and we're going to talk about the first one, which is probably not surprising to anybody here, the covered ratio strangle. You're going to see this term ratio multiple times throughout this, and it's because I purposefully use ratios to create different risk to reward profiles. And this is what I'm talking about. So the first trade we have here is a short put, and this is the payoff. It's a max profit of the credit received, so that's why it has a capped max profit and technically unlimited downside. Now, one note on these short puts that I want to make sure it's abundantly clear is I purposely put short puts, not cash secured puts. And the reason why I don't put cash secured puts here is because some people think that if it's a cash secured put, then we're parking the cash that we're going to use for that trade if we get assigned and just waiting to see whether or not that happens. That is not at all what I used to do. At this point, I generally do that because I have enough room in the portfolio. But when I was aggressively growing my account, trading things like this, the money that I would earmark to take assignment if the option expired in the money and I received the stock, in that scenario, I would typically have that money out doing something else, whether it's a box spread, whether it's being tied up in another trade. And to cover early assignment, if it happened, I would rely on margin for the account, pay the interest on the margin until I could free up the capital to bring over to this that I originally had earmarked. So to summarize that, when I was aggressively growing the account, my short puts were not sitting there cash secured. I would use the money elsewhere. I would have the money earmarked to use in this trade when I need it. But I typically would expect and plan to free up that money towards expiration. So that did leave me early expiration risk, and I needed to make sure I had enough room in the portfolio to at least be able to take on the shares via margin. Now, let's talk about that scenario. There's 2 outcomes with this short put. The first one, it expires out of the money and you just do it again. Or if it expires in the money and we take assignment, that leads to this scenario. And that's what this looks like down here. We have now long stock because we would have bought it at whatever the strike price was, keeping the credit. And then I sell calls against it, just like a covered call, and then additional short puts. So in this scenario, sometimes the short puts go on right away. Sometimes they get layered on later. It all depends on the underlying. But the main thing I'm trying to avoid is this. So in this scenario, I'm pretending that I have 200 shares of long stock and this short put. On top of that, we have this 1 short call. So I have 1 short call here, 200 long shares over here. And that's why we do not have a capped upside. Whereas if we look over here, this is using 200 or 100 shares, but the same amount of short calls. So if this is 200 long shares of stock, even with that additional put, this is 200 or 2 short calls against it. And sooner or later, you're going to cap out your max profit. I don't want to do that. So that's exactly why I trade these as I do without capping the profit potential. So these live within my core allocation, meaning this is really how I make a lot of my money over time. They're bullish in their nature. I want the underlying to go up through all stages of trading this. And I put volatility indifferent. The reason why I put volatility indifferent is because when we're selling short puts, if we have higher volatility, it's a good thing because you're going to collect a little bit more money. But it also means that you're going to have higher variance in the underlying's movements, which means even though you're getting paid more, you're probably going to have to adjust the trade more frequently as compared to low volatility environments. So it's a trade-off. That's why I don't say this is better for high IVP environments. I get paid a little bit more, but there's a diminishing return. So I prefer implied volatility percentile to be maybe 30 to 40%, something like that. And as soon as it starts getting over that, I'm going to make more money, but I'm going to have to deal with the trade more. So it's a bit of a delicate balance. And I will trade this strategy even if implied volatility is low. It's not better for the strategy. It's not the ideal scenario, but because it is a core allocation and because there's a period of time where you have long stock, which doesn't really care about volatility, that is why I label this implied volatility indifferent. All right, let's get on to the next one here. So we have ratio diagonals. Again, that same ratio thing that we're talking about. And this works for calls or puts. And this is how I can easily directionally trade bull and bear markets. So in this scenario, if we have a trending bull market, using the call diagonal gives us upside potential. And again, this ratio is so important because the ratio unlocks unlimited profit potential. Whereas if we look at this version with a regular diagonal, sooner or later, you find yourself in this scenario where you actually can start losing money. Even though your direction that you selected is correct, you can still start losing money. So this is exactly why I prefer to trade them at a ratio. And again, to set up this long call diagonal, typically ratio diagonal, typically I'm going to go further out in time for the long call, like maybe at least 180 days plus. And I'm going to go deep in the money. And then I'm going to sell short calls against it shorter term. And it's the same thing for the put side, just inversed. And again, notice how by trading these at a ratio, I have unlimited downside profit potential in this scenario because this is a bearish play. So sometimes this can live in the core allocation, sometimes speculative for me. I split these up very purposefully. I have a video that will walk through that for those that are interested. I'll throw it in the video or in the video notes below. And then again, this can be bullish or bearish environments. And again, I call this volatility indifferent. I use volatility indifferent because there are trade-offs here. So the reason the core position here is the long option that's far out in time and deep in the money. Vega or changes in volatility do not impact the price of those options that much. That is the heart and soul of the position. But regardless, the long option is going to prefer, in general, lower volatility because if volatility expands, you can make money via it. So there's that side. But then we also have the short call or short put that we're selling against the long call or the long put respectively. And that would prefer high implied volatility. So generally speaking, this is going to be your short near term option is going to be way more sensitive to changes in volatility. So there's a benefit there. And the longer term options are going to be less sensitive to changes in volatility. So again, there's trade-offs here. It's different parts of the trade like different changes in volatility. But overall, I will still trade these in varying volatility environments. It's not necessarily the heart and soul of the trade. Let's move on now to the next one. Let's talk about short single options. These take a pretty different shape for me. This is when I want to trade directionally. So if we have a high volatility environment that's trending one way or the other, I will use short calls or short puts to take advantage of it. Now notice in this scenario, I most certainly have a volatility preference. I want implied volatility percentile to be high. And it's because a major part of this trade is the movements in volatility. Whereas with these trades, they have different aspects that benefit from different portions of volatility movements. These not so much. Even though if I sell a short call or short put, again, there's a higher probability that I'm going to have to deal with it at some point because if we have high implied volatility percentile, we're expecting bigger moves. That's a big part of the compensation for these trades. So these are definitely speculative. This is when I want to get directional. And again, if you trade a short call, you're going to be bearish. If you trade a short put, you're going to be bullish. But these normally for me would be traded via margin and not cash secured like the Strangle. On to the next. Two more. We have short ratio straddle strangles. I bucket these into the same category essentially because it's a similar concept, just slight differences. And this is when we're going to sell a call and put typically in the same expiration cycle. If we're doing straddles, it's going to be in the same series and it's going to look like this. It's going to have a peaky top. And strangles, it's going to have more of this flat top. And it's just because for short straddles, we're going to use the same strike trying to get as close to the same deltas on the call and put side. Whereas for the strangles, we typically are going to pick, same deltas, but I'm sorry, the same figure delta, but on the respective side. So for the short straddle, short strangles, or I'm sorry, for the short straddles, normally we're going to go right at the money, something like that. For short strangles, I might do a 30-40 delta call and a 30-40 delta short put. So it's going to put them at staggered strike prices as compared to the straddles. And this ratio I apply to both. If I have a pure volatility play in my mind, I'm going to gravitate towards a straddle. But if I have a slight directional preference, but I still want to play volatility very directly, I sometimes will skew the straddle, less likely than not. More often than not, I'm going to go with strangles if I have some sort of preference for direction. So more often than not, these are going to be speculative trades specifically for volatility, not so much I don't expect the market to move. And I want you to see this here that really codifies that. I want to see a big variance between implied volatility and historic volatility, specifically where implied volatility is tracking higher than historic volatility. That is the name of the game. We want to sell volatility that is overpriced compared to what's being realized. So this is definitely going to be tied to volatility trading. This is not, I don't have an opinion on where the market's going, so I'm just going to try to be neutral. This is, I have an opinion on volatility, and it's that implied volatility is overpriced compared to historic volatility. A lot of people get that mixed up with these trades. They want to just, they can't pick a market direction, so they want to be neutral. But what you are trading volatility with these strategies, and you got to know that. All right, last one here. Long single options. Sometimes I use these if I'm buying units, meaning really far out of the money, long puts, expecting kind of a large movement in an underlying, or if I want to use leverage to speculate in a direction, but these are more rare than not. A good example for something like this is more often than not, I'm going to end up turning it into a diagonal, but sometimes not. So what I mean by that is I have some long out of the money calls in HUT. I'm not really expecting much out of that trade. It didn't work in my favor, but I used the long calls to essentially serve as my risk management, meaning I had a defined risk moving into the trade. It's cryptocurrency. They move a lot, and I fully expected it to be a shit show. So I used long call instead of buying the stock and setting a stop. I wanted to give it enough room to move. So in this case, I used options to gain exposure to that. The problem with using long singles to speculate on direction is even though you think you're speculating on direction, you are still speculating on volatility, and that cannot be overstated enough. If you are trading long single options just because you want to more efficiently, in terms of capital use, gain exposure, directional exposure to an underlying to trade a hypothesis, regardless of how you feel about the direction, volatility still has a big say in this scenario. So in this example, notice what I have down here. I'm not necessarily just looking for low implied volatility. I prefer low implied volatility because similar to short single options, it will increase my overall profitability if I get an implied volatility movement in my favor. But really what I'm looking for here is a low variance between implied volatility and historic volatility. I don't want to be overpaying for volatility. That is the main thing I'm looking for here. So that's the first threshold. If that can happen, and I can also obtain low implied volatility, meaning I have room for implied volatility to expand. That's a great scenario to be in, but the main thing is checking out the variance. So these are 5 of my favorite strategies and their derivatives on how I trade different market conditions. This year, it's been a lot of volatility trading for sure. And that's been the heart and soul between earnings, FOMC announcements, economic announcements, and then still, as always, running the covered strangle. I almost always have exposure to the covered strangle out there because it works so well for me over time. I've developed a great way to manage it. I will link to videos for all of these in the description below so that you can check out any of the ones that you like. Don't forget to subscribe, like the video. See you all later. Be an outlier.